Good morning and welcome to our investment and model portfolio update for April 2022. My name is Anthony and today I have Andrew from the investment committee here today to discuss our portfolios. How are you today?
Yeah, great. Thanks, Anthony. Thanks for having me here.
No problem at all. Now, just a quick disclaimer. This is general advice only. Please contact your wealth partner if you would like any additional personal advice. Investments are not capital guaranteed, and past performance is not an indicator of future performance. Now, when we last met in February, inflation was one of our key discussion points. Could you please give us an update since then?
Yeah, absolutely. The main news point or talking point since our February update is obviously the Russian invasion of Ukraine. That has had some flow-on effects to financial markets. Obviously, we've seen commodity prices increase quite significantly. The one that people are probably noticing the most is the increase in fuel prices. However, it extends beyond that. We've seen wheat prices increase considerably. Iron ore, coal. There's quite a list of commodities there that have had some significant price rises throughout the year to date. Now, if we already had inflation concerns before the Russia-Ukraine conflict kicked off, these commodity price increases are only going to add to that situation. So that then potentially leads us into interest rates rising faster than may have previously been expected. However, the total number of rate rises hasn't, or the expectation around that hasn't really changed too much. It's just the pace of rate rises that has increased quite a bit since we last met.
Fantastic. And can you explain how conflict and geopolitical events has traditionally impacted the financial markets then?
Yeah, so I mean, this one's quite surprising because a lot of people would expect quite a significant event on share markets from these geopolitical events. However, if we actually have a look at this data that goes back to 1969 through to present, the impact on markets really hasn't been as significant as you might expect. So if we go and we have a look at the Russia invasion of Ukraine, obviously that one's still playing out. We're yet to see how long a complete recovery takes with that. But some of the other events down here, for example, the US terrorist attacks or September 11, once the markets reopened, it took about 10 days for them to bottom out, and then only 30 days to recover and reach their pre-event highs. Iraqi invasion of Kuwait was a little bit more prolonged. It took 57 days for the market to bottom out, and then 200 days, or a little bit over 6.5 months, for the market to recover. So when we have a look at this here, there's no real evidence of a connection between geopolitical events and significant long-term falls in markets. Even if we have a look at how much the markets fell by, we see the Iraqi invasion of Kuwait being a 19.1% drop. Look, it's significant, but we've certainly had more significant events that are not geopolitically connected, such as the global financial crisis, tech wreck, and other events over those times.
Fantastic. And then how are the markets performing this time around then?
Yeah, so if we have a look over on the left-hand side of this illustration here, we've got two of the international share funds that sit in our model portfolios. Now, the green that you can see is the return over the last 3 months, and obviously they are the worst performing assets for the last 3 months. However, over the course of the last 12 months, investors have actually been rewarded quite handsomely by being in these investments, which are up around about 14% for 12 months, and then their 3-year average returns are rather similar as well. So even with the drop, investors are well ahead by being participants in those investments over the course of the last 12 months. If we move on to Australian markets, and what we can actually see here is Australian high dividend yield fund, SYI, that sits in our portfolios is just up marginally over the course of the last 3 months, and its 12-month return is very similar to the international funds. But if we actually dive a little bit deeper and have a look at what's happening in different sectors of the Australian market, we can see the resources sector has actually been quite a strong performer over the last 3 months, up around about 9%. So this is your BHPs, your Rio Tintos, your Newcrests, your Fortescues, those kind of businesses that are actually benefiting from commodity prices having increased. So they've performed quite well. What we sort of see from this, or the takeaway we have from this, is the importance of rebalancing a portfolio on a regular basis. Now, that can be done by selling down investments that have performed well, so set them back to your original intended allocation or weighting in a portfolio, or for investors who are still contributing, obviously they would be using those inflows or those contributions to tilt towards those investments that may be representing a little bit less of their portfolio than what the original intended allocation was. The other thing that investors need to be mindful of is when we have a look at the returns from portfolios or a certain investment, is not getting too confident in how a particular investment has performed, because it doesn't necessarily mean that it's going to be able to sustain that level of performance, and potentially rebalancing can allow you to take a little bit of profit, be happy with the return that you've got out of that investment, then move to other sectors and readjust your risk and return profile. If we move on just a little bit further, we can see that gold mining stocks have been one of the best performers over the course of the last 12 months. As the gold price goes up, obviously the gold miners will benefit from that. One of the interesting things that we've got here is the iShares Core Composite Bond Fund, which is traditionally a defensive investment in portfolios. It's actually down over the course of the last 3 months and 12 months, and only got a minor positive performance over the course of the last 3 years. That's really a reflection of interest rates expected to rise, because what's happening with bonds is you are locking in current interest rates for a period of time. In this fund, it sits around about 5 years. So as interest rates rise, if you're locked in at lower rates, potentially your investments may not look as attractive as new fixed income assets come into market. Precious metals, again, a lot of that does sit with gold, but there's also silver, platinum, palladium, performing quite well over the last 3 months. However, over the last 12 months, only a marginally positive return. Still looking good over 3 years, though. And then wrapping it up, we've got the Fidelity Emerging Markets ETF that sits in our portfolios. No surprises there. Emerging markets have been impacted by current tensions. One thing I just want to point out there, though, is the allocation to emerging, or to Russia, in the Fidelity Emerging Markets ETF prior to the conflict was around about 3.5% of that fund. That fund represents around about 6% of the total weighting in even our growth portfolio. So the actual underlying exposure for our clients directly to Russia was rather minimal. Fidelity took the steps to actually liquidate as much of the Russian holdings as they could after the invasion and prior to Russia cutting off international investors from transacting in the market. So they were able to bring that 3.5% down to 1% before the markets were closed to international investors. They've actually written off that 1% holding. So that is a contributor to why that fund is down over the course of the last 3 months.
Sure. And with all that in consideration, what changes are you looking to make to the portfolios?
So the changes predominantly sit in the defensive element of the portfolios. So what that means is the impacts or the changes we're making are going to have the greatest impact on the moderate and balanced portfolios. Growth and high growth will see minor changes. What we're looking to do is remove the iShares Core Composite Bond ETF from the portfolios. The yield on it's relatively low at the moment. Rising interest rates can potentially have a negative impact on the valuation of the portfolio, we see more attractive opportunity in the likes of the Metrics Opportunity Trust, which is an existing investment in the portfolio. What Metrics are able to do is increase the interest income they receive on the loans they provide to borrowers as interest rates rise. So we're not getting locked in at lower rates. Then the other thing that we're looking to do here is use gold as a more of a risk management tool in the portfolios, just given that the bonds that have traditionally provided that risk management mechanism are not necessarily going to fulfill that purpose as we move into a rising rate environment. So they're the only changes we're looking to make at this point in time, but it's not to say that we won't recommend more changes in the near future.
Sure. And then what are the key takeaways for investors?
Yeah, so the main things that we want to look at here is rebalancing portfolios, not being hesitant to take profit on investments that have performed well and reallocate elsewhere. It can help you reduce risk in the times of a downturn. Look, the other side of rebalancing is when markets do fall, is to actually rebalance back the other way, because what it effectively does is it results in you're selling high and buying low by rebalancing a portfolio on a regular basis, which is what we should be doing as investors. The other point that I want to make is that we see a lot of negative headlines in the markets at the moment, but that's not to say that opportunities don't exist. And we've seen that in the likes of the resources fund, the gold mine funds. There are opportunities out there. We've just got to make sure that the portfolios are positioned appropriately for that.
Excellent. Well, Andrew, thank you very much for this April 2022 update. If anybody would like additional advice, please reach out to your wealth partner directly and they can provide you with that assistance.